It seems like everyone is concentrating on the haves and similar issues. Needless to say, that's everything. Since this is the case, ETFs are significant. Important is the halving. For the few months leading up to the halving, it won't make much of a difference. The continuous hardening of Bitcoin is, extremely significant. However, there is a great deal of volatility around the halves when one examines previous bull runs. The timing was more impacted by liquidity than the halving alone. And I would argue that this is due in significant part to that fact, because the amount of Bitcoin entering the market and having to be absorbed is crucial. Particularly in a bear market, the halving helps set up higher highs and higher lows. I think liquidity is a far more important factor when deciding on the real timing, whether it's 3 months, 6 months, or 12 months. Lyn Alden, a macro expert, recently spoke with us and gave us a detailed rundown of the April Bitcoin halving. There has been a robust relationship between liquidity cycles and Bitcoin halvings in the past. This means that the amount of monetary stimulus, rather than the halves, will be the primary determinant determining whether or not there is a substantial bull run in 2024 and 2025. If you stick around to the very end of the film, Alden discusses the reactions to BlackRock's market depth and the obstacles she sees ahead for Bitcoin. Their ETFs will prove useful, in my opinion. Some think they're a sell the news event, but others disagree. Many investors used exchange-traded funds, and the results for the first quarter were disappointing. You never know, maybe the cash doesn't magically appear as fast as everyone expects. The idea that huge pools of wealth with tens of trillions of dollars in them might be allocated as little as 5% or 3% is, in my opinion, quite implausible and unlikely to materialize anytime soon. One way I've described it is that for some time now, people have recognized that a 60-40 stock portfolio with a little portion in gold enhances risk-adjusted returns. This is because there are times when bonds and equities both do poorly, but gold does well. Decades like the 2000s and the 1970s are good examples of times when even that small piece is quite useful. Despite this, the allocation is still below expectations based on those figures. Bitcoin now functions similarly to rocket fuel. Just have a look at the Nakamoto portfolio or any number of other resources that demonstrate the impact of even a little holding of Bitcoin on your investment portfolio. In terms of risk-adjusted returns, it's astronomical, so it should, right? You'd think people would start using it more often. However, investment decisions are sometimes delayed by certain conventional pools of cash. In most cases, decisions may be made quickly in a small business when the owner holds a majority ownership. It's not uncommon for the founder to retain significant decision-making power in publicly traded companies. Take MicroStrategy as an example. They have the power to make judgments more quickly and with more certainty. It can take a lot longer to actually make a meaningful adjustment to a portfolio strategy in companies with far more dispersed decision-making. I agree that ETFs have the potential to be useful, though perhaps not in the ways that most people anticipate. Still, I have faith. A liquidity issue or stagnation in 2024 is another possible obstacle. In my opinion, it may simply be another instance of sluggish liquidity. A liquidity crisis is not necessary. As a result, Bitcoin experiences choppy liquidity for around 6 months, and it releases some of the consensus steam. Finally, in 2025, you may run for office, I see. Predicting any of those outcomes is therefore not my intention. To be honest, I wouldn't be surprised in the least if, by year's end, Bitcoin had dropped into the upper 30s or was already in the 6 figures. The asset is that unpredictable, and there's a lot of subtle variation. I have no idea what will happen in 2024, but I am far more certain about what will happen in 2024 and 2025 when combined. Therefore, I felt much more at ease making 2-year forecasts. Thus, it is entirely possible that all these individuals are super bowled over by 2024 and that their expectations aren't completely rescheduled, say, 6 to 12 months from now. It seems like there are quite a few situations like that. No dissemination has been detected thus far. So, when Bitcoin experiences big bull runs, some of the older holders usually start to sell into the strength of the market. They might want to rebalance their holdings or just buy that house they wanted but couldn't afford before. With the influx of new customers, you can observe a portion of that distribution. And according to any kind of chain analysis, you look at that process hasn't even begun yet. This structural bull run is still in its early stages, in my opinion. However, I believe that one should not disregard a bull run. Just because it's on that cycle or that the halving is happening doesn't mean it's owed to you. Having said that, I do believe it is still likely to occur within the next 2 years. But you need to manage your expectations and risk appropriately. It is worth noting that the Grayscale Bitcoin Trust now possesses around 500,000 Bitcoin. Therefore, I would argue that a portion of the concentration of custody risk that could arise from ETFs has already occurred. The vast majority of Bitcoin holders do not feel that way. It's great that they're more dispersed. However, there are a few large pools that may eventually pose problems with confiscation or pricing, and that won't materialize either. Something like that is already present. In theory, they can already be captured because they are large enough pools. Personally, I don't see any way around that. In other words, any big liquid asset will eventually have an exchange-traded fund that banks would want to keep it for their clients or themselves. Thus, this was certain to happen at some point for Bitcoin if it was successful. It's not like there's no way to confront it, therefore, it begs the question, is Bitcoin architecture prepared to handle it? In my opinion, yes. However, that remains an additional test that it must complete. It had to survive the conflict over block sizes. It had to overcome some initial network issues. A way through was necessary. Some nations have outright outlawed it only to later reverse their stance along the path. There are obstacles. In my opinion, this is only another obstacle that will eventually appear. Accordingly, there are benefits and drawbacks to institutional liquidity. The first and most apparent drawback is that you shouldn't keep a large amount of Bitcoin in exchange-traded funds or other highly regulated, capturable silos. That is a disadvantage. One positive aspect is that vast pools of capital can be automatically rebalanced and there is more liquidity, which can help reduce volatility. This makes it a better money for non-custodial users, particularly in poor nations. Reason being, most individuals will cite Bitcoin's volatility as the main reason they don't utilize it. Both they and the market are unprepared for its volatility. Consequently, more of the modest, self-custodial buyers may be enticed if it grows larger, more liquid, and more commonly owned. For that reason, I rank it first. Also, the privacy issue is a major one. The government doesn't care if you own Bitcoin so long as it's locked up in a secure location. You can have custody of it, but they want to know who you are and how much according to the second one. The third is that they are strongly opposed to private Bitcoin moving about on its own, because it undermines the foundation of their present system and poses a challenge to their income tax model and their ability to control punishment. This is why they are so opposed to it. And I believe that the most significant argument that will be debated this decade is that although prices may be doing well, they aren't actually making as much of a difference as you would expect due to these frictions. The silver lining is that it has been extremely challenging to implement thus far. So as an example, bear in mind that despite Nigeria's decision to cut off Bitcoin from its banking system, the country maintained one of the world's highest adoption rates and, more specifically, the highest peer-to-peer trading volume as reported by Chainalysis. This was achieved by navigating around the bank blockage. Next, we noticed that the Nigeria Central Bank is somewhat rolling back their decision in the past few weeks. This may be seen as an admission that they made a mistake. After all, their blanket ban wasn't working, so now they want to try to bring it back in and regulate it a bit. Even India changed its mind on this. Maybe we can learn something from Argentina's experience, as they did something similar. They didn't outright forbid ownership, but they did say that banks couldn't be too involved